Hi, welcome to the Interaxis YouTube channel and Interaxis.io. We're going to talk in several videos now about lending and blockchain and how the two go together and why we're so excited now about the prospects of lending, debt, and the combination of blockchain technologies, whether that's pure cryptocurrency, decentralized finance, or some sort of centralized finance, some sort of supply chain, trade finance, whatever it might be. But the utilization and the implementation of blockchain technology, decentralized ledger technology, and lending. Now, first we have to talk about why we're so excited about this, why this is such an exciting topic for us. And that is in the answer that there is over $250 trillion in debt. Okay, 250 trillion in worldwide debt. That is a monstrous number. Debt and lending makes the world go round. This is why, this is the whole purpose. This is why the global economy is able to grow. It is because of debt and lending. It is not at all because of equity investments. It is not at all because of ownership. It is because of debt. This is the only way that the world economy functions and has grown in the way that it grows. And we're going to talk a little bit about all the ways that blockchain is kind of helping. But first we have to go talk about really what lending is. Why is it important? Why is it even here? And then we can break into all the different ways that blockchain is impacting or will impact or has been impacted by the idea of debt and lending. So remember this $250 trillion number. But the very basics of debt and the very basics of lending comes back to this. And I go back to my Adam and Ron example all the time, right? So Adam has, we'll call it $100,000 lying around doing nothing, came into it, whatever it might be. And for the most part, it could be sitting in a checking account, or it could be sitting in a savings account not doing a whole lot. Then there's Ron over here. And he says, look, I have this great idea for a business, whatever it might be. It's going to make 15%, 20% annualized return, but I don't have any cash. I don't have a lot of cash on me. So if we know each other and there's some level of trust there, okay, Ron shows me his business plan. I go, okay, this is great. I know Ron. I know he's an upstanding person. He's going to do everything he can to pay me back. I go, okay, I will lend you the $100,000. Now you get to borrow $100,000, and what I get in return is I get interest. Now this is the very basis of lending. One person has extra money, one person needs some money to do something that I can't do. Ron might have this business idea and it's not something that I'm capable of doing. I don't have the expertise or the knowledge or the network, or I just don't have time, right? I might be doing so. I might be a doctor. Like, that's my job, but I have extra money and I want to give it to someone else to do something with. Now I can go invest it in the market. I can go, invest it in some other companies. I can go buy real estate or buy some sort of asset myself that I hope goes up in value. But this might be, or I go, look, I want to lend money to Ron. I have money, he needs money. This is how lending works. He pays me some sort of interest, okay? So in this case, let's call it 6% interest. That means that every year I'm going to get $6,000, 6% interest, right? $6,000 on my $100,000 loan. Okay, and we decide how we're going to structure it. It might be he pays me every month or every quarter, or he pays me annually just the interest until he can pay me back the principal, right? This is the principal, this is the interest. That's the nomenclature here. So that is the essence of lending. Now that relationship has obviously been scaled and multiplied over and over again, but it's not this exact relationship. Most of the time there isn't this level of trust between two individuals, okay? We have to outsource that trust and this relationship to others. That's where we get banks and lending companies and monster private equity and monster hedge funds and institutional investors that lend. That's where we get all that, because we have to outsource this little relationship. One person has money, one person needs money, there is interest that is paid for the use of that money so that this person, this company, whatever it is, can do something better with it. Ron now has to make sure that he can make more than 6%. So if he can make 12%, 15% on this $100,000 and he can make $12,000 a year, then he can pay me 6 and he gets to keep the other 6. Okay, now hopefully he's got some business where he can make much more than that, but that's the gist of it. That's the gist of lending. One person has money, one person needs it to do something else that they're going to make a higher return on than this rate of interest. That's it. Now, to go more with the nomenclature of all the parts of this deal, I might ask Ron to put up some level of collateral, right? Collateral, in this case, we can make it anything we want, but I might say, Ron, all right, I understand that you're using this $100,000 to go start your business, and I can just have blind faith that whatever business that you're going into is going to make some money. But I might say, look, I want some sort of collateral. You have a really nice truck. I think your truck is worth $30,000, so we're going to use your truck as collateral. Okay, that might be the collateral. And Ron, if you can't pay me, then I get your truck. And it's got some value to me. I'll probably go sell it for whatever I can get it for and get a little bit of my money back. I might say, Ron, I'm going to use your house as collateral. Your house isn't worth $100,000. Your house is worth $250,000. I'm going to use that as collateral. Ron probably doesn't want to do that because he doesn't want to lose his house. Okay, and his house might already be mortgaged or something. That is way over collateralization, but it compensates me a little bit for the pain it is to try to take his house if he doesn't pay. Right? That's not an easy process. But that would be collateral. Ron offers me something that says, if I can't pay you back your principal, your interest, you can have this other thing, something else. The easiest thing Ron might say is, okay, look, I have these other investments. I have money in the stock market or whatever. I can offer you that as collateral so that because that's the easiest for him to give me, right? So that if he can't pay me back, I have these other assets that I can give you. And for that, I might go, all right, I'll take $90,000 in collateral if it's securities, if it's equity, if it's public stock, whatever it might be, funds, to secure this loan. Okay, so that is how lending essentially works. Again, there's a person that has money who is the lender, and the person who needs the money, which is the borrower. And I know I've made this very basic, but we have to get some of the terms in here correct so that we can move forward. Now, what has happened is, again, this relationship doesn't always scale very well because I don't have time to go look for people. If I have this money sitting here burning a hole in my wallet, right, sitting in my bank account earning nothing, I do not have time to go find people who need money for some sort of company, for something they're going to do that's going to earn more. I don't have time for that. Ron doesn't have the ability necessarily to find all the people who have money available. Right? That takes quite a bit of time. So what we've developed is companies here in the middle who take care of some of this process, right? And some of the process that they take care of is what's called underwriting. So I can put my money in here. Now this can be a bank in the easiest case, right? Where I say, look, bank, you're going to hold on to my money. You're going to keep it safe, right? Because I don't want to lose my $100,000, and you're going to pay me some very small percentage to basically have my money. Now that bank is actually going to take that, called fractional reserve banking, right? They're going to take that and they're going to lend Ron potentially the $100,000. Now the bank has taken on this intermediary role to where I don't care what they do on this side. I just care that they keep my money safe and they pay me my interest for holding my money, potentially, even though this is a very small amount, because I'm more concerned with the safety. But let's say that their whole job is to go out and find these loans, right? They need to find people. Well, Ron knows to go to the bank, that's who you go to potentially to get a loan, right? That's one of the stops you go, am I bankable? Can I get a bank loan? Okay, now the bank is going to do what's called underwriting. And the underwriting is they're going to look at potentially the business plan. They're going to look at Ron's credit. They're going to look at whatever Ron can offer as collateral. They're going to look at the structure of the company, everything like that, and they're going to go, are we good making this loan? And if they say, yes, this is all good, he's got a good business plan, he has good credit, he's offering something as collateral, which might be something else that he has, holding with us here at the bank, then yeah, we'll give him this $100,000 loan. He will pay us, 7% interest based on the riskiness, and we get to make $7,000 a year. The bank then, keeps the money, they have their fees and everything else, and they pay me some level, but I'm separated from this part. Okay, I don't really care what happens over here. Now, let's say that this is not a bank, but it's a company who is expressly in the market of making loans. Okay, so in this case, I might be an investor. Okay, now I invest in whatever this company is. This could be a BDC, which is called a business development company, or it could be some other kind of company where all they do is make loans. Okay, so now I've invested my $100,000 and I'm outsourcing my trust to this company. And I'm not in this to say, hey, I need you to hold my money safe like a bank so that I can write checks or use a debit card or whatever it might be. I need you to grow my money. And this BDC will take $100,000 from me and $50,000 from some other investors, and they'll get a bunch of other investors. And what we're buying into is their ability to underwrite. Okay, so this is no longer about keeping our money safe. This is about their ability to underwrite loans. So they're going to find the people like Ron who need to borrow money. They're going to look at, again, their business plan, their credit, collateral maybe, etc., and they're going to say, we'll lend you money, but we might charge maybe they charge a little bit higher percent because this might be a little bit riskier. If Ron isn't necessarily bankable, if he doesn't have a bunch of collateral or a long history of businesses like this might be a little bit riskier. Well, this company can take on that extra level of risk because, one, they're going to get a higher interest rate in return for using their money, but they are not tasked with making sure to keep my money safe necessarily anymore because they're not a bank. They're just a company that is in the business of lending money. So their job is to find more people like me who have money lying around who want to earn interest, and then their other job on this side is to underwrite these loans, to find people, find good businesses where they can make a high rate of return, because if they can make 8, maybe they can pay me 4. Well, I'd rather have 4 than the 0.01% I'm making in the bank, right? If I'm okay with the fact that they're not guaranteeing to keep my money safe. This money is not insured by the federal government or anything. So I have to be okay with that. Okay, so what we're going down is all the different places where blockchain or something might fit in, because you have these intermediaries. Here's an intermediary, right? Here's a way that they're gathering money, right? This intermediary is making money, right? They're making potentially is 4% here. There might be some fees on this side. They're underwriting, so I'm paying them for their underwriting ability, basically. And they might come to me and they say, look, here's our criteria. Here's what we look at. We only look at tech entrepreneurs who have done this in the past, and here's what we do. There might be some that say, hey, we get really high rates of interest. So we charge 20% interest, which means we can pay you 12%, which would be great, except we only look for companies in Central American countries who are in some sort of business. And I might go, well, there's quite a bit of risk there. Like, I'm a little bit worried about my risk, but I'm okay with it because of the higher return, right? So as the risk goes up, the return has to go up. Okay, so that's a little bit more about how lending is going to work. The idea of blockchain potentially is to maybe take out this intermediary, okay, maybe to provide some sort of protocol, some sort of code that becomes this intermediary, and therefore doesn't have to make as high a percentage in here. So if they charge 20%, then I can maybe get 18, because a piece of code doesn't really need to make a whole lot of money, because you can scale a piece of code over and over again, right? So that is some of where we might see blockchain fit in. Now, some of the other areas where we've had to see blockchain, where we talk about it in the world of crypto, it's not necessarily a blockchain application, but where do we have to see it? Well, what we've seen also is Bitcoin and other cryptos are assets, right? It's an asset class. People hold them. But part of the reason why I might want to hold an asset, or part of what I might look for in holding an asset is, can I use it as collateral? Well, we just talked about it as collateral in a bank loan or in some other loan setting. We talked about collateral, where Ron might have used his car, or he might have used his home, or he might have used some equities he has. Well, for years, Bitcoin and other digital assets were not able to be used as collateral, but now we are seeing that change. We have companies, and we'll talk about this in another video, like BlockFi, like Drawbridge, like Genesis, that are lending out tremendous amounts of money, and they're using cryptocurrency, using Bitcoin and potentially Ether as collateral for those loans. They're seeing it as collateral. They understand it as an asset. They understand how they can hold on to it, maybe wrap it in a smart contract or something, and use that as collateral. That is big for the crypto as an asset class world, for the institutional investor world, because now if they can hold the cryptocurrency and use it as an asset, as collateral, that they can go get a loan, that is big, because then that means they can hold Bitcoin as hopefully Bitcoin goes up in value, and still get a loan using it as collateral, and go do something else with their cash, right? They're not locking up cash. It's not illiquid. We've talked in several videos about illiquidity. It is no longer as illiquid because they can get a loan against it. Now, we also talk about this in the world of security tokens. Right, we did a whole 2 weeks on security tokens, on real world assets on chain. Well, now if you have security tokens, right, so if I invest in some sort of real estate token, and now I can use that real estate token as collateral because of its digital nature, because it is on chain, because if I default on my payment, then the lender can then take that as collateral, and they can take it in a digital way where title is actually transferred to them. That is a big deal for in the collateral world. Now I can invest in real estate deals and have those deals, have my investment in those deals be used as collateral. That is not an option right now as much in the traditional world. So tokens and cryptocurrency and digital assets being utilized as collateral is a big deal in the lending world. Right. Then we go back to my Adam and Ron example again to see where this is fitting in, and we have this ability for peer-to-peer lending. Right, peer-to-peer lending, right? And this is, there's Adam and there's Ron, right? I have money, Ron needs money, but are we able to find each other, right? So we need to find each other. Now, in the traditional world, that's not all that easy. And again, there might be intermediaries. There's companies like Lending Club and Prosper that actually, they'll go underwrite and then they'll find me and they'll kind of put us together, but not really. There are ways to find each other, but there are protocols being built to say Ron's going to put in X amount of information here, and he might connect a wallet in the crypto world, and the wallet might read about him, and we might have new forms of credit reporting and new forms of credit ability on chain, and people like me who can put my 100,000 DAI in here, and I might find people. So there might be this marketplace of people looking for money, and I don't know who Ron is, but I know Ron's wallet. And Ron's wallet says it fits all my criteria, and therefore I'm willing to lend him money. That is the potential for peer-to-peer. It's the ability to expand the participants, because the participants can be put into digital terms, right? They can be put into wallets. They can be put into credit scoring that doesn't get all the personal information. We can make it private. We can decide what information we're looking at, and I can put money in here, lend it to Ron. Ron can put up some sort of digital collateral that I can take if necessary if he doesn't pay me back. That is available here. Now, that can be, of course, we've seen the lending protocols. So they're somewhat peer-to-peer, but they're the protocols right, where the money goes in here into this protocol. My DAI or ETH or whatever cryptocurrency goes in here to this protocol, and it is making the loans out here, basically just using collateral. They don't care what Ron's credit is, they're just using collateral, and Ron has to over collateralize this loan. Well, I get an interest rate that is going up and down with the market based on the number of people that are borrowing. And this is algorithmically driven, right? So there's no people that have to be watching this. This is, in the form of like Compound. Compound is the protocol that is lending out money on one side, essentially borrowing it on the other. My money goes in, I provide liquidity so that it can then lend money out on the other side with collateral, that if the collateral goes down in value, it just liquidates, pulls the collateral in, pays me back my money, and I get sometimes a good interest rate, sometimes not so good interest rate. It's changing all the time, but the fact is my money's relatively safe sitting in a smart contract, and we're just worried about smart contract risk. So these are all the ways that the fact that we can sometimes take the personalization out of it. Sometimes we can take the people out. We can make it more private. That is another aspect. So we have all these different aspects where blockchain is really helping us. We have the ability to collateralize assets. Okay, so we have the peer-to-peer aspect of blockchain. That's really decentralized finance and the ability to put people together that don't have to know each other. We have the as an asset class, right, where are we going to use Bitcoin? Are we going to use Ether as collateral? We have the security token aspect now. Are we going to be able to use security tokens, digital assets, digital representation of real world assets as collateral? And here you get into things like trade finance, right? Because now you're looking at invoices, you're looking at factoring, you're looking at quick 5-day, 10-day, 20-day, 30-day financing for companies on trade. I'm going to buy goods from you, but I'll pay for them in 30 days, and I'm going to try to turn them around faster than that to have the cash to pay you back and to pay my people. We have that. Then, even beyond that, we just have what can the blockchain tech do to make administration cheaper and easier? Can we just use the technology to make things cheaper and easier? And once we have that, once we have loans and information on chain, then what can we do with it? Can we package it up and make other assets out of it? And then you get back here, right? Because if you can take a bunch of loans that you've done on chain, you have all that data. Now you can look over it in an algorithmic way. You can just write code that says, I'm going to look over all the loans that are here, and I'm going to buy a whole bunch of them, and I'm going to create a security token, and I can use that as an asset class. You see how it moves over here. So what we're going to talk about in the next few weeks is all these things. We're going to talk about peer-to-peer, obviously, with decentralized finance. We're going to talk about how important it is now that Bitcoin and Ether can be used as collateral and what helps them as an asset class. We've talked at length about security tokens and real-world assets, but we're going to talk about them in relation to trade finance, in relation to, of course, using them as collateral, as an asset class, and how that is going to help the market. And we'll talk about the administration, how blockchain and decentralized ledger technologies are helping the administration of loans and helping the administration of the debt market, and where we're seeing that grow. Okay, so much to talk about when it comes to lending, because lending is, again, it makes the world economy go. $250 trillion in debt outstanding, and it's not all bad. A lot of it is very necessary and great and moves the world economy forward. So that's that's a lot about lending. There's so much to tackle here, so much to talk about. We hope that you'll subscribe so that you can keep up to date. Interaxis.io is the website. Visit us on Twitter at Interaxis8, the number 8. Please don't forget to subscribe here. We'll see you in the next video.